Welcome, everyone. The market volatility since New Year's has left many investors nervous about what 2022 has in store for them. In today's webinar, JFL Total Wealth Management reviews some key learnings from 2021 and then focuses on 2022's economic outlook. We don't have a crystal ball, but we do have historical perspective on the impact inflation, rising interest rates, and other economic factors have had on the markets previously. We also have strategic recommendations on what investors can do today in the areas they can control. Without further ado, let's introduce our two panelists. Jeannie Kane has an MBA from Duke University and is a certified financial planner. She has extensive experience with analyzing and managing our private clients' portfolios and with developing comprehensive financial plans. Jerry Lynch is a certified financial planner and has been an independent financial advisor for nearly 25 years, working in the financial industry for more than 30.
Welcome, everyone.
Welcome.
Great. All right, Jeannie, do you want to get us started?
Yeah, thanks, Gretchen. So today we're going to look at last year in review. We'll look at what happened in the stock market and also what happened with inflation. Looking forward to 2022, we'll talk a little bit about interest rates, market predictions, and then what you can do as an investor. So let's get it off with 2021. And before we talk specifically about last year, I wanted to take a longer historical look. Now this chart represents the Dow Jones Industrial Average over the past 40 years. As you can see, stocks have increased over the long term, but there have been some market pullbacks and dips along the way. Now say I'm an investor, but I've got some pretty terrible timing, and I bought into the Dow at the peak of the global financial crisis in 2008. It would have been really tempting for me to get out of the market, but I remained consistent, stayed in the market through all of the ups and downs that followed. And in 14 years, I would have had a 300% return. Staying disciplined, not getting emotional, and really sticking to your investment strategy during times of volatility can be crucial to delivering a well-designed long-term financial plan. Now in 2021, the US stock market ended the year just shy of all-time highs. The S&P 500 rose 27% last year, and it was the third consecutive year that the S&P ended the year with double-digit gains. In fact, the S&P 500 hit an all-time high 70 times last year, and the Dow Jones Industrial Average had 45 record closes. Now recall my last chart. Think about how many times that upward sloping graph has hit all-time highs during your lifetime. Now, many investors think that a market high, that's going to signal that, it is signaling that stocks are overvalued or they've reached a peak, that it must mean a drop is coming. Well, you might be surprised to find out, the average returns for the S&P 500 on a 1, 3, 5 years after a new market high, they have similar returns to the average returns for the index over any 1, 3, or 5 year period. And just because you hit a high, it doesn't mean a decline is coming. It's really important to look at the fundamentals of what's going on in the economy and the markets overall. And many analysts are crediting ultra low interest rates and a healthy economic recovery for this recent surge. Now, interest rates continue to be very low throughout 2021. Now, there's something in finance called the rule of 72, and it tells you, how many years it's going to take for you to double your money. And it's a simple calculation where you take 72 and you divide it by your interest rate or your rate of return, and then it tells you the number of years for the money to double. Now, for money markets last year, or last week even, at 0.07%, that's going to take your money 1,029 years for it to double. A 12-month CD at 0.14%, that's going to take 514 years. But a balanced stock portfolio, return 7.2%, that's a 10-year time frame for your money to double. And at today's inflation, you're guaranteed to lose money if you're only invested in these very, very low interest rate products like a money market or CDs. And it really highlights the importance of maintaining a well-balanced portfolio. Now, the second I word we heard a lot about in 2021 was inflation. And inflation happens when, simply said, there's too much money chasing too few goods. Inflation rose at its fastest pace in nearly 4 decades in December. The number was 7% higher versus the year prior. And a little inflation isn't always a bad thing. The Fed actually targets 2% as its ideal. But too much inflation makes it harder for your dollars to buy what you could have in the past. And if you've been to the grocery store lately, you've probably noticed a much higher bill for what you usually pick up at the store. Now, inflation can have an impact on your real rate of return. It's lower when you factor in inflation. So a 10% return on your investments is cut to 3 if there's 7% inflation rate. And inflation is clearly on our watch list for 2022. So the Fed has tools that they can use to kind of cool down a hot market and put pressure on inflation. The first of these tools is interest rates. And when the Fed raises interest rates, they've effectively made it more expensive to borrow money. If it's more expensive to borrow money, that's less money in the economy and less money chasing goods. Now, the Fed has been signaling for a while that they're going to be raising interest rates. And they actually are going to start raising them this March. And they plan to raise them 3 times this year, 3 times next year. So at the end of 2024, their projected interest rates would be at 2.1%. The second thing that the Fed can do is that they can kind of adjust the timeline for their buyback strategy of bonds. The Fed had been buying about $30 million worth of US debt a month since the start of the pandemic. And when they buy these bonds back, they're paying bondholders, so money is going out into the economy. They've been gradually slowing down the number of bonds that they've been buying back with the goal that they'll be done by March of this year. Now I'm going to turn it over to Jerry. He's going to talk about 2022.
Okay, welcome to 2022. We have a couple of things we're going to kind of go through today. Again, first, we're going to start with the business cycle. So a normal business cycle works like this. You have a peak, you have a decline, you have a bottom, you have a rise, and then you have a peak again. Right now, we're in a mid-cycle expansion, and we had mid-cycle mainly because of 2000. A lot of the job market got messed up, and also in 2021. So we're still on the rise in terms of the business cycle. There's easy financial conditions making it very simple for people to get money. So there's some very positive things that are out there. Now on the risk side, on the bad side, we have supply chain issues. And again, that's affecting growth, and it's making things a lot more expensive than it was in the past because people can't get the products they need to be able to develop their products. Financial conditions may tighten more than expected. As interest rates start rising, it's going to make it harder and harder for businesses to borrow money, making it harder for them to make a profit. Mixed vaccine rates across the United States may produce uneven rates of recovery. And with uneven rates, there are pockets of the country which are going to have areas where they have higher COVID that's going to slow down businesses. And again, it's interesting because a little widget that's made in Ohio can have an impact across the entire United States if it's not dealt with in a systematic basis. So the asset allocation implications are basically stay in stocks, remain overweighted to risky assets, generally appropriate if you have the time to basically stay invested. There's going to be volatility. There's definitely going to be volatility that's out there for a variety of different reasons that Jeannie was talking about, and some that we're going to also hit as well. Emphasize the focus of diversified and disciplined investment strategies. Remain consistent in your approach, and over a period of time, you're going to get consistent returns. That's the key to investing. Now, if we take a look at 2021 and what were the investment forecasts from the economic gurus that are out there, we have 3, one from Wells Fargo, one from Bank of America, and one from Morgan Stanley. And my generally joke on economic outlooks is that economists will tell you what they predict, and at the end of the year, they'll come back and tell you why their predictions were not accurate. So while there was a lot of negative information that was out there going into 2021, we actually had a very good year. The market was one of the best that we've had, where the S&P closed up roughly 22% higher than it was predicted. We actually had a very good year in the stock market. Had some volatility so far year to date with some of the major indexes being down anywhere 5 to 10% or even more, but we're seeing that starting to come back up again. And this is part of a normal economic cycle. So it's nothing really to be worried about. Now, again, if I take a look at what's reasonable in the stock market, so again, the average negative year in the stock market, if you take a look at all the times we've had negative returns and you average them out, the average negative return when the market is down is 16.3%, and it goes back to 1928. So if you're looking at a 5 or 10% loss in the market, we haven't even hit the average yet. So this is something that I'm not overly concerned about. But if you take a look at what happens on average in the stock market, 95% of the time, you're going to see a decline of 5% or more. 63% of the time, excuse me, 63% of the time, you're going to see a decline of 10% or worse. 26% of the time, 20%. You see what the numbers are. But bottom line is, the market does not go up straight all the time. And again, when you're seeing these declines, I think these declines are reasonable. Over a 72-year period of time, the S&P on average has experienced corrections once every 2 years, a bear market once every 7 years, which is a 20% dip in the market, and a crash once out of every 12 years. And if you think about it, since 2008, we've had one negative year, which was 2018, since the market crash of 2008. So again, when I'm looking at things, it's definitely reasonable we could have some volatility out there, but I don't think any of the things we're seeing out there are very, very long-term situations. Now, again, when you take a look at the equity markets, downturns are definitely uncomfortable. There is nobody out there that will tell you losing money at any point is not a uncomfortable experience, but it's not unfamiliar. It's something that happens on a regular basis. The equity markets always offer exit and entry points. The problem is most people flip the switches and they do it the wrong time. Volatility brings more opportunities to buy and rebalance at a lower price. If I could buy a stock at $100 or I could buy a stock at 75, I would prefer to buy it at a lower price, which is what we are offering now. Now, again, 2021, if we take a look at this, and actually this is a stock market from 2018, and I could go back and say, what would be the perfect time for me to dump money into the stock market? I would have chose 2020. That is an entry point. Now, what happened there is we had in a 4-week period of decline, we had a 40% discount in the market in a 4-week period of time. Many people were thinking they wanted to get out. Many did. Some remained consistent. Some, the smartest, invested through that period of time. And between that point in 2020 and the end of the year, those people that invested in that market decline got about a 65% rate of return. So my point would be is that when you have these declines in the market, it is not a selling opportunity. It is a buying opportunity. And if you look back over these period of times, any of these dips would have been great opportunities to buy on a systematic basis throughout that market condition. Now, if we take a look at what happens when rates change, and again, if you look at 12 months prior, you're looking at a 15 to 20% gain in the market. 6 months, you're still looking at a 10 to 15. 3 months prior, you're still seeing some pretty good returns. After that, yes, it's not growing at the extent it was prior to that. But if you look after 12 months, and even if you look after 24 months, you're still seeing some pretty substantial gains in the market. So my point would be is that, yes, while interest rates rising does have a negative impact on the market, the impact is really negative over a period of time. And especially if you use this as a buying opportunity, you could take advantage of these dips that are occurring. So if you look at 2022, there's a variety of different challenges that we have that are out there. First and foremost, you have COVID, which again is coming. There are variants. There's all different types of things that are happening. There are rising interest rates, which are definitely going to make it more expensive for businesses to raise money and basically grow their business. You have continued inflation, and that's not going to stop for a period of time. I would say at minimum, we're going to see this rate of inflation continuing for at least 12 months, possibly even longer. The Fed tapering of bonds is going to push less money out into the economy, which again is going to have a negative impact to a certain extent. Labor market, again, I'm concerned about it. Businesses want to hire people. They can't find them for whatever reason. I think that's going to take care of itself over a period of time. And because there is such a demand for labor, you're seeing a rise in interest in wages for people that they are hiring within these businesses. And the struggling Build Back a Better plan from Biden, it doesn't look like that's going to go in the original form, but there may be some variation of that to basically come out. And then finally, there's what are known as the FANG stocks, which have a huge impact on the major indexes that are out there because they comprise so much of the market. Companies like Apple, Amazon, Netflix, Google, Facebook, these have a big impact. But again, I am not overly concerned about any of these issues because I think these things will figure themselves out over a period of time. Now, if you talk about investments and diversification, you usually have a chart like this. And all I'm going to do is basically, if I take a look at 2019, growth stocks were the #1 area in 2019, and they were in 2020. In 2021, they weren't the top one. So a lot of times people are basically taking a look at the stock market. They're seeing what was the hottest category in Money Magazine for the previous year, and they're putting their money into it. And my point would be is that when you're looking at, let's just say REITs in 2020, it was the worst market sector that was out there, down 8%. Following year, it was up 43%. This basically means that you need to systematically change your investments, reallocate, and making sure that you're in all the different markets that are out there. This reduces the volatility that your portfolio has, and it's simply a better way to invest in the long term. So if we're looking at 2022, there's a couple of things that you should be thinking about doing right now. #1, review your income producing investments. Generally, what we're suggesting to people is have conservative short-term bonds, higher quality. We're not going for high interest rates here. We're basically looking for stability of principal. Tips are Treasury inflation protected securities that do well in a rising interest rate environment because they have a crediting rate that's tied into inflation. #2, lock in your mortgage rate. If you have an adjustable rate, get out of that, get a fixed rate, lock it in for a 30-year period of time. If interest rates rise, you want to make sure that you have locked in a long-term interest rate. For every 1% interest rates rise, your mortgage payment per 100,000 is going to increase by about $80 per month. Now, again, if you have a 15-year, it's going to be a little bit different, but that's on a 30-year. #3, maintain liquidity, short term. If you're retired, make sure you have 5 years worth of income available to support. If there's a market decline, this allows you to spend for the next 5 years, not having to sell stocks at a discount. If you're actively at work, have a 6-month emergency fund so that if something happens with work, with the house, with the kids, we have a plan B and we don't have to sell stocks that have been targeted for long-term growth. Finally, confirm your cash flow needs. How much does it cost for you to live? Anything above that, if you have the 6-month emergency, should be systematically invested systematically invested into the market. Again, I don't care if the market is down right now. I care that reasonably 5 to 10 years from now, the stock market should be substantially higher than it is right now. I want to take advantage of these dips in the market. So important things to remember. #1, if you are in a 401k plan, you could contribute more in 2022 than you did in 2021. The limit this year is $20,500. If you're over the age of 50, you could contribute another $6,500. If you're self-employed, you can contribute into a SEP or solo 401k plan, and the new annual limit for the year is $61,000. If you're over the age of 50, you could do another $6,500. Secondly, if you're over 72 and a half, the IRS has changed the life expectancy tables and have decreased how much you need to be taken out in your 70s and 80s. So this is a one-time reset for inherited IRAs as well too. So take a look at that. We could give you some thoughts there. Okay, a few things. So the economic update should have come out recently. If you didn't get it, give us a call. Let us know. We want to make sure you're on our distribution list. There is excellent information that comes out in our monthly newsletters. We could send them to you either electronically or paper, whatever works best. We will be coming back in the next few months and talk about special needs trusts, identity theft, and a couple of investing in real estate. So there are a few different areas that we're going to be involved with. So I think the key takeaways for today is #1, equity markets ended on a high note, and there's going to be a lot of things that are going to make it volatile in 2022. That's just how it works. inflation is still expected to be prominent throughout 2022. We have supply chain issues. We have employers scrambling to get new employees. That's going to cause inflation. I would expect that to happen for the next year or two. Expect 3 rate hikes in 2022. That's what the Fed has said. So again, interest rates are definitely going up. Tapering efforts from the Fed will begin to double beginning in mid-January, meaning that they're going to be buying less and less bonds, which will have an impact on the volatility that's out there as well. Volatility is around, and it will be at least for the next 6 to 12 months. Just count on it. But volatility is your friend when you're investing. And focus on our own personal goals and objectives. If you have a long period of time to basically from where you are now to when you retire, I don't care that the market's down. I care that it's a great buying opportunity. And if I could go back in time to 2020, 2008, or any of the declines we have, I would go back and invest a little bit more aggressively. So some of the things that you should take from us is, again, we're going to have regular communications. When we see issues that are impacting you and all of our clients, we want to make sure we're having newsletters that apply. We're doing a lot of these videos to make sure that you're aware of what's happening out there. We will continue to have frequent discussions in terms of what we see and how you need to be adjusting your portfolio based on that. And then if you're an individual working with us, we have systematic reviews on our 401k plans. We will also do systematic reviews with you to make sure that we're making sure the investments are appropriate for where you are and making sure that you understand the issues that are facing all of us in this type of economy. So I wanted to thank everybody for their time today. If you have any questions, please let us know. Again, we have a whole webinar series on our website. You can see that on the right. Just click there and it'll take you there. So we have everything from long-term care to reverse mortgages to investing in volatile markets. Again, I want to thank every one of you for your time, and I look forward to continue working with you. Thanks again and have a great day.